Hello everyone. Welcome to this webinar brought to you by Kenanga Investment Bank in collaboration with Bursa Malaysia. Today's our webinar's topic is Kenanga Technology Sector Outlook, Sell Out or Selective Opportunities. So hello everybody, this is Shen Chu. I'm the moderator for this session. Today we are very excited to bring to you this technology sector outlook. I guess many of you here would be very interested to see whether is this sell down in the technology sector an opportunity or is a sell out. All right. I think since the earlier this year, we have seen that the technology stock has been hammered down. Okay, I think no thanks to the hawkish Federal Reserve. And then after that, in February, we have this Russia-Ukraine war that changed the sentiment in the market. So is this sell down an opportunity? So today we have invited the senior equity analyst of Kenanga Research to come and share with us his opinion about the technology sector. Right. So before we begin, as usual, disclaimer, whatever you share on this webinar is only for educational purpose. So in no way that I give any recommendation for you to buy or sell any listed company that we do mention here in this session. So if you decide to make any investment decisions, you're 100% responsible for all your investment risks. So allow me to briefly introduce Samuel's background. So Samuel is a senior equity analyst of Kenanga Research. So he joined Kenanga as a senior analyst in 2019 and has been covering the technology sector for 5 years. So he has won back-to-back the Edge Best Call Award for 2020 and 2021 on DNO, KGB, and PIE. So Samuel graduated with a Bachelor's of Commerce degree from Monash University, majoring in banking, finance, and economics. So without further ado, let us welcome Mr. Samuel Tan.
Hi. Thanks so much, Shane, for the introduction, and thanks everyone for dialing in this evening, taking out time from your evening. So I can share my screen, is it, Sean?
Yes, please go ahead.
Shane, sorry.
Yeah, go ahead.
Are you able to see?
Yes, seeing your screen right now. Perfect. So can't wait to hear from you.
Okay, thanks. So to start off, again, thanks everyone for dialing in this evening. And I believe everyone has enjoyed a good run in the tech sector over the past 2 years, despite COVID. In fact, its tech stocks actually did even better due to this pandemic, which encourages a lot of usage of end devices and also and a lot of things relating to tech. So just to get an overview of what is happening since 2022, we can see that since the start of 2022, we see a lot of sell down, and the local institutional investors remain the largest seller. For year to date, they are out 7B, and we can see foreigners were the one buying in Malaysia. But this foreign buying, I believe it's mainly going into other sectors, such as plantation or maybe a bit of oil and gas. In fact, plantation is the sector that actually benefited a lot from foreigners. So which is quite surprising when it started that way, because foreigners were the party that always penalized the plantation companies due to ESG. But I think given the fact that there was some instability in the foreign market, in the Western market, that foreigners came to Malaysia to park their temporary money into plantation, despite the ESG concern that they always emphasize about. So this is why the sell down in local guys for our tech stocks did not see anybody buying back a lot. That explains the negative sentiment on the tech sector. But if you look closely, January, February, March, you can see local institutional were ramping up on their sell down. But come April, it seems to tame down a bit. And for May month to date, we can see that local selling has actually cooled down a lot compared to maybe back in 2 months or 3 months back in early this year. We believe this is one of the signs that maybe the local selling has started to ease back a bit. And I guess at this kind of level, which I will explain further down, that there would be a lot of companies selectively that gives a good value, those that are still fundamentally sound and currently has come down in terms of valuation, would still deserve a very good consideration for investors to actually enter into these names again. Okay, so here is a quick overview of the tech sector. So as you know, the whole pandemic started off with working from home trend, and this has actually driven a lot of people to buy laptops, buy PC, tablets, smartphone in order to adapt to the change in the way people conduct meetings or people conduct their lessons in school or university. And going into this 2022, this would be the third year of said work from home trend. So if you judge by that kind of the being a third year, you can see that, or you can just analyze the friends or your family relatives. You can see that those who actually wanted to upgrade their laptop, their PC to adapt to this pandemic would have already done so in the past 2 years. And given that this is the third year, I believe things will actually stabilize a bit and it start to cool off a bit. So I believe for the end devices and consumer electronics, 2022 would be the year where it actually stabilize or plateau a bit. You wouldn't see much growth. In fact, if you look at the shipment statistics for laptops, PC, for fourth quarter 2021, it was only up 1% year on year, which is quite a low growth, given that fourth quarter is usually the better quarter for this kind of electronic shipment. And using back the fourth quarter 2021, you look at the smartphone shipment, it was actually down 1.8% year on year. So you can see that these are signs that the shipment volume will actually start to cool off a bit. In fact, we also talked to companies like, if you're familiar with VS Tech actually does a lot of all this trading of consumer electronics. In fact, if you walk in the Lau Yat Mall, I think almost 90% of the retail shops in Plaza Lau Yat get their stocks from VS Tech. So even VS Tech's management voiced the same kind of trend also, that the consumer electronics side is stabilizing already. So the consumer electronics side will not be able to see the kind of growth that they did back, say, 2 years ago when the pandemic started. So on that front, I am actually neutral on this side. Okay. So another thing that would be people will perceive as bad. So I segregate into 3 parts. First is the negative side, then the middle part is the neutral, and the bottom is the positive side for tech. Secondly, people are concerned of inflation. Inflation is a valid concern, as you see. I mean, globally and locally, central banks are raising rates to actually curb inflation, as we have enjoyed a low interest rate for the past 2 years or so, and liquidity has been pumped into the market aggressively. So what people worry is, for tech players, is that are they able to maintain their margins given the rise in logistical costs, the rise in minimum wages, and the rise in material costs. But in short, I'm still confident that companies, or the good companies that I've identified, will be able to maintain their margins going forward, and they can enjoy the same margins or similar margins they have been doing for the past 2 to 3 years, given that, you see, back in the days, say 5-6 years ago, we have always been the back-end semicon players. So the back-end semicon always get pressed down in terms of pricing by the front-end guys when price starts to increase. But fast forward to recently, 2 years ago and up to today, you can hear from a lot of corporates, probably a lot of tech corporates you have attended over Kenanga's webinar. You can see corporates are mentioning that they are able to revise their price upwards, which is quite unheard of, because back last time, you always hear companies complaining that their front-end customer always ask for cost down every year. But recently, tech players said they can even revise their price upwards. So even not just for new orders, but for some matured packages. And this is because the front-end customers are being more sensitive to the fact that costs of production of semiconductor chips across the board has risen. And they are being more, how you would say, more sympathetic on that sense of understanding, and they are willing to actually share the higher costs of the local guys in Malaysia. So local guys are able to also raise their ASP again a bit from that end. So that's why I think on that front, companies in Malaysia are able to still maintain the kind of margins or similar to the kind of margins they have been doing for the past 2 years. And on interest rate side, things, of course, as everyone knows, interest rate is bad for companies who are highly leveraged. But if you look at the tech companies in Malaysia, I think 9 out of 10 or 8 out of 10 of them are in a good net cash position. For example, MPI has around 900 to 1 B of cash in their bank account. Inari has around also 1 B of cash in their bank account. So interest rate on the rise, I don't think that will impact a lot on the fact that companies are tech companies, in terms of their capex plan or their expansion plan, they are still able to expand their capacity, their floor space, build new factory with the cash they have in hand. But of course, this interest rate thing again started the whole ball rolling of the sell down incident, because I think it is very different because interest rate going up in US, affecting US tech companies is actually quite a significant thing, because a lot of tech companies in US are actually software based. And a good example is that, and it's also near from home, is probably Grab. Grab is listed in US. They are a software based tech company, but they are still making losses. So those kind of software company which is fighting for user-based market share and has to spend a lot of software development costs to actually grow their app, and also to spend a lot of marketing just to increase their user base. Those are fighting for market share. Those are very highly impacted by higher interest rates because they are burning cash to gain market share. But back home, our tech guys are quite different. We are not really in that game. We are hardware semiconductor, and we have been doing this for the past many decades. So on the semiconductor local tech company, you can see that most of our balance sheets we're actually in a net cash position, and it's quite strong to actually fund capex going forward. But it's another thing that is going to be still negative for the tech sentiment is China's zero COVID policy. As you know, as funny as it may sound, that this China zero COVID policy, some may say is really a case of trying to curb down the virus. Some say it's because of political reasons, but we can see that this policy is actually quite drastic. For example, on the right, you can see there was 2 months ago, Foxconn have to actually suspend their iPhone factories in Shenzhen because of a lockdown. And this lockdown comes because of 66 new cases in Shenzhen. And during that time, we have 30,000 cases in Malaysia and we are open already. So this is quite drastic on China's side in terms of doing a lockdown just with 60 over cases. So, but this is going to be ongoing thing as we check with some of the management. So they just have to be prepared, take contingency for plans for this kind of thing. But the works on the ground still carry on, just that during this kind of zero COVID lockdown kind of implementation, companies have to quarantine their workers in China on the work site. So they will eat, sleep there, lodging will be provided, but the jobs will be carried on, although there may be a bit of inefficiency. But thankfully, this is not a nationwide China lockdown, but it's on a province by province kind of individual lockdowns. Okay. What is neutral for the tech market would be the USD MYR. I think earlier on, I think I said this as neutral, but it seems that it's turning into more of a positive. So earlier, why I say it's neutral, because the Fed raising their rates is going to boost USD. And as you know, tech companies all generate their revenue in USD, which is good for them. But why I say neutral earlier on is because there's also rising interest for CPO and also Brent oil. So that should boost the MYR. But if you can see recently, after the 50 basis point hike, I think a few days back, USD actually soared so high, I think close to 4.39, 4.4 already against the ringgit. So it's turning to a bit more of a positive for tech company because again, they generate revenue by selling in USD. As for the minimum wage, I think it's quite neutral for tech companies because as you know, during the COVID period, there was no foreign labor coming into Malaysia. So it is a fact that a lot of EMS companies, the operators that were in Malaysia before the lockdown were able to generate monthly income higher than fresh grad or so. And this is quite a normal thing for the past 1 year, 2 years. So these foreign workers were able to get more than fresh grads in this EMS factory workers. So the minimum wage hike from 1,002 to 1,005 would actually be not much of an impact to tech companies because they are already paying their existing workers so high. In fact, in terms of plant, working in a plant as a plant operator, I think the tech plant should be getting more than say the working in a plantation estate or a factory that is producing gloves. So I think the tech sector will be the least impacted from this minimum wage compared relatively to other sectors like the glove side or the palm oil side. Okay, and for the Russia-Ukraine war, this is mainly just bad for sentiment. But if you look at fundamental impact, I think it's very much negligible, which I will explain later in the next slide. So what could be the positive things for tech sector to drive it going forward? I think the trade diversion will continue to benefit all our tech guys, especially in the Penang side. And this is also tied to the China zero COVID case policy. So if you are an MNC and you're looking to expand floor space, I think if you are going through this China zero policy, and if China is going to hold strong on this zero policy going forward, I think even MNC will actually think twice, should I actually expand in China at the risk of being locked down as and when the Chinese government want, or would I expand in Penang, where it's a tech hub in Malaysia and Malaysia is a neutral ground and it's not siding US or China per se. That's why I think Penang will continue to see very favorable FDIs into the local scene. Okay, and what I'm still bullish on, as I mentioned earlier, I'm neutral on end devices like laptops, consumer electronics, but what I'm still bullish on is actually the data centers. So this is because the end devices, smartphones and tablets, those we have bought it over the past 2 years. I think even my parents, who is so much elderly, have 5G smartphones already, but they still can't use 5G. And why is this? It's because the lack of infrastructure. And that is the part that I'm still bullish on, which is relating to 5G base station, data centers to facilitate the 5G transmission, and also the automotive semicon market, which is seeing still a lot of momentum going forward as car manufacturers are being forced by regulators of respective countries to include more EV models into their lineup, simply because they have to meet the regulators' carbon emission target. And if you don't meet that certain threshold, you'll be fined a huge sum of money. So that's why a lot of car manufacturers nowadays are including more EV into their lineups in order to bring down the average carbon emission as a company. And this will continue to drive a lot of demand for automotive semiconductors. As you see, the automotive market has been seeing a shortage of chips since the beginning of MCO1. And up till today, the shortage is still there. So those are the sub-segments of tech that I'm still bullish on. Okay. And lastly is the reopening of our local borders. So this would help the local tech companies to get more labors. As you know, we have been shortage of labors for the longest time. And a lot of tech companies say with the reopening of restaurants and what, a lot of some of the workers would want to work in the service sectors or the F&B sector, which is not that tiring, but that has forced a lot of companies to have to incentivize their current workers to actually keep the retention rate. So the reopening of borders will help these companies get more foreign workers into Malaysia in order to actually get back the efficiencies they want, because currently or towards the past 1-2 years, it has been juggling in the sense that workers come and go very infrequently. So you have to retrain workers, and then your U rates are actually coming down. That's affecting your net profit margin. So with the reopening of that, it will help alleviate some of these problems. Okay, so this slide would be mainly about the Russia-Ukraine war. As you can see that the Russia-Ukraine war is the second major factor that contributed to the sell down of tech stocks. But if you look at it closely, if you follow what SIA, which is the Semicon Industry Association, where it actually is an association where members underneath includes the likes of Apple, Intel, Samsung, Huawei, so on and so forth. They actually do a global statistics of semiconductor consumption, and you can see that Russia actually only accounts for 0.1% of global chip purchases. So if Apple decides to stop selling iPhones to Russia, it's actually not going to be it's not going to be impacting global demand or anything, because it's just 0.1%. In fact, Apple not selling to Russia will actually be better for the Chinese companies, because after Apple, Xiaomi is the biggest one already in terms of smartphone market share, and the vacuum that is left behind by Apple or Samsung could be easily taken up by the Chinese guys to sell more in the Russian market. So on that, it is actually quite negligible for this Russia-Ukraine war to justify that kind of sell down. If you look at Russia's contribution to Apple revenue, is also around just 1 to 2% annually. So you can see that the impact is actually much less than what the sell down is actually implying. So this is just some fundamental facts to share. But what could be more significant to look at is the usage of neon gases. As some of you might know that neon gas is actually quite a critical component used in the manufacturing of semiconductors. And Ukraine is producing 50% of the global's usage. And this is not just normal neon gases, these are semiconductor grade neon gases. And because of the breakout of the war, the Ukraine side had to slow down their production or stop their production in some areas to protect the employees. And due to that, we can see that prices of neon actually went up more than 500% since December last year. And just a background on how these neon gases are produced. Basically, it comes from an air separation unit. And if you are familiar with some of these gases, you know that ASU actually produce three main types of gases, which is oxygen, nitrogen, and argon. So, and the two main producers in Ukraine are Ingus and Cryon. And these two companies alone produce 50% of global supply. So during the process of, say, the production of oxygen, you would actually produce a byproduct known as neon. So for smaller companies who don't have the financial strength or the space or the expertise, they will actually release neon into the air or use neon for other low-end usage, such as signboards like this one. But if you want to use it for semiconductor production of chips, you have to actually take another step to purify those neon gases. So those neon, when it come out from the ASU, is only 30 to 40% purity, and those smaller guys will just release it into the air. But those bigger companies like Ingus and Cryon, they would take an extra step to purify it up to 99.999%, which is the minimum requirement for it to be graded as semiconductor usable. And when these gases are purified to that level, it will be mainly used in the process of photolithography. So if you're familiar with the type production cycle, you know that photolithography is the process that actually gives you the names that you always hear in the market, like the 7 nanometer, 5 nanometer, 10 nanometer. And these are names quite often used in maybe the launch of every iPhone. Say the new iPhone with the new A14 Bionic chip produced by TSMC with a 7 nanometer process. And this 7 nanometer process is known in the industry as photolithography. It's basically using a light source, and you have to go through multiple mirrors to reflect the light source and narrow it down the light beam width to actually 7 nanometer. And in order to generate this light source, which is known as the ultraviolet laser, you have to use neon, because neon is a compound that will create excitement or a reaction between argon and fluorine. Then only the burst of ultraviolet photons is able to be generated, and this would be projected on the semiconductor wafer. And that is where you have your new Intel processor based on 10 nanometer, or your new MacBook M1 chip with a 5 nanometer process. So this is the whole process, and this is why neon is so important in the semiconductor market. But this is not the first time that actually Ukraine has to, say, stop their production. Back in 2014, some of you may recall that Russia also attacked the Crimean Peninsula. And during that period in 2014, Ukraine had to stop their production to protect their citizens. And during that time, prices of neon also rose up to 600%. But since that incident in 2014, a lot of large wafer fabs like TSMC, Samsung, Intel, they have actually learned from that incident and start to prepare in case of something happening again, which is what is happening now today. So since then, they have actually prepared some safety stocks. And because these big names, they have good buying power, so they are able to get a lot of this in their inventory to stock up for times like this. And since then, some even has their in-house recycling process. So TSMC even built a neon recycling, their in-house recycling process below their plant, which is underground. So the ground zero will be where they are manufacturing their chips, where the photolithography process happened. Then below ground zero is where they would actually have their in-house recycling system to recycle those neon gases to be used. So you can see that Taiwan also came out to say that they see limited impact from the Ukraine war, and they will be able to continue producing the chips as they want. And alternatively, those smaller guys who does not has that buying power, which equivalents to the likes of TSMC or Intel, they can actually switch their source to China. And smaller names like Global Foundries, maybe Micron, they definitely would see some shortage after a quarter of running out of neon gases, but they can always source it from China. And China has so much of these neon gases simply because of their strength in the steel production. As you know, China produces a lot of steel, and in the process of producing steel, you actually use a lot of oxygen. And this goes back to here, because you use a lot of oxygen, you have a lot of neon as your byproduct. So that's why China has a lot of this kind of, we call it noble gases, be it neon, argon, krypton. So these gases are quite, the supply in China is quite a lot. So, but the trick here is whether the Western guys like Global Foundries or Micron, are they quick enough or actually quick enough to switch their source to China, or actually whether they want to switch to China. So that remains something to be seen. But for bigger names like TSMC, Intel, Samsung, they won't be having a problem because they have the buying power, the safety stocks, and they can easily source from China if they want also. So you can see that China also, suppliers are ramping up the supply of this kind of noble gases in order to meet the increasing demand, not just from overseas, but also China locally. As you know, SMIC is one of the top 3 largest wafer fab in the world. Okay, so that is the macro side of things, where we talk about what is affecting the tech market and so on and so forth. So now we go into a bit more micro side, which is company specific. And since the sell down, we can see on the right, year to date, companies has fallen, some has fallen up to 50% year to date. But on average, I think everyone is at least 20 to 30% down year to date. So how do we navigate through this kind of situation in 2022, given that some market dynamics has actually changed? And over here is how I actually map out the valuation of some of the more familiar names in the tech space. Of course, not everyone is here, but I think those are here are actually quite familiar to the audience. And I actually segregate it into 3 periods. So this is all PE valuation on the left, and on the right is the percentage, is the comparison of today's PE valuation with the respective historical valuations on the left. So for period 1, basically is using a 3-year average of a pre-COVID kind of situation. This, I believe, I would say it's a very conservative period, because period 1, where it's pre-COVID, basically it is also pre-5G and it is also pre-EV. So basically valuations here on average are actually not factoring in the prospects of 5G or EV and the surge in demand for laptops and tablets, so on and so forth. And period 2 in the middle, period 2 is the average, which benefited a lot from elevated PE because of monetary easing in the market, not just in Malaysia, but in the US. The Feds actually pump in a lot of liquidity, locals, government also pump in a lot of liquidity, and there is a lot of new participants in the equity market during period 2, during the COVID period, simply because I think everyone is at home, and then probably the casinos are closed or the 4D operators are closed. So suddenly there's a surge in participants in the equity market in period 2. So I think, and period 3 basically is a 5-year average of both 1 and 2. So period 3, I believe it's a fair period to actually look at tech stocks now, because we are way past period 2. Period 2, because now is going towards a monetary tightening kind of phase where banks are increasing rates to actually curb down inflation. So period 3 is a 5-year average which encompasses the conservative PE in period 1, and also some of the fundamental benefits that tech stocks actually saw in period 2, because some might think that stocks should be valued back at period 1, pre-COVID era, which I tend to disagree, because if you use period 1, basically you are saying that stocks should be trading at a level by stripping out the prospects of 5G and EV. So period 3, I believe, is a more fair period, I would say, because it have a good balance between those two periods. And taking into account some of the technology advancement, the 5G proliferation, and also the EV prospects that came in all in period 2. But period 3 also encompasses some of period 1, so it balances out the monetary easing part in period 2 with the conservative kind of PE in the pre-COVID era. And if you look at on the right-hand side, basically you can see that a lot of companies are trading actually at a discount to their 5-year average. So to read this chart, you can say that D&O is trading at a 15% discount to their 5-year average PE. And if for some companies that I believe has good prospects, good fundamentals, nothing has changed, I would be comfortable to actually use +1 standard deviation to their 5-year average. And that would say that D&O is actually trading at 38% discount to their 5-year +1 standard deviation average. So this is how I actually compare the valuation of current tech stocks. And I believe this is a good way to navigate through this period. Of course, we have been used with the past 2 years that tech stocks is always going up and average 1 to 2% every day. But given that market dynamics have changed a bit, liquidity has come down a bit in the market, and the fear of monetary tightening is still in the market, lingering in the market. So we have to take a different approach to investing, say, in tech stocks. Of course, we can't expect tech stocks to go up 2% every day until the year end, right? So by taking a more realistic approach, you can still invest in tech stocks, but your horizon has to be a bit longer. So if you believe company X or company Y have actually good fundamentals, nothing has changed, but valuation has come down and at a discount to their 5-year average seems to be very, there's a lot of value there, then it's good to go into that particular company with the expectation of a longer horizon compared with the past 2 years. Yeah, so this is a chart that I'm always using to actually see where our valuations at. And of course, some names you see like KSM, or they are 48% below their 5-year average. So it's a big discount, so it's cheap. But then again, it's some are particularly cheap for a reason. So KSM, sadly to say, if you are following them closely, you can see they actually did not benefit anything for the past 2 years in the tech run, which is quite unfortunate for them. In fact, during the tech run, they were even making some quarters are making losses. So this is due to some fundamental reasons that is more micro related. But for a gist or general rule of thumb, those that you see are at a discount, then you go and evaluate further on how are their fundamentals holding up. Then if both are in a positive region, then you know that company is still a good company to look at. So that's how you can actually see tech companies with this kind of method or approach. First is to see how is their valuation compared to historical 5 years. And if it's at a discount, why is it at a discount? Then you check the fundamentals. If it's still on a growth trajectory, then and you are confident that the prospects are still good, then it's a good buy. So this chart is just a simple overview on the three main declines that I can see on the Nasdaq. So this is the breakout of COVID, so down 32%. The one prior to that is in around 2018, it was down 23%, but recently it is down 30%. So the quantum of decline is quite near to that of the first breakout of COVID globally, which is in 2020. So this how I would interpret this is that I would see that it seems that the decline would stabilize. I can't say for today or tomorrow, but it should be stabilizing in quite soon, I believe. It will not, I don't think the tech stocks will come down to the pre-COVID era, which is not justifiable because these tech stocks actually, aside from the boost from liquidity, they actually got boost because of good fundamentals and a lot of technological advancement that actually drive the valuation of these companies. So if those who are saying that tech stocks should come back to their pre-COVID level, I think that is quite unfair to say that. Comparatively in Malaysia, the first breakout of COVID, the KL Tech Index was down 45%, and from the peak recently, we are down 38%. So it seems that we are quite near the kind of decline that we saw at the first MCO1. So I think from this standpoint, it seems that the downside may be less compared to the, say, back into 2-3 months. And if you can relate it back to the earlier fund flows I shared in the first slide, you can see that the selling from local institutions are actually cooling off a bit already. Yeah. So so that is what I'm trying to get across. And this is just a snapshot on how market actually reacts to the rate hike. So just a fun fact, we saw that in early March, just before the first 25 basis point rate hike from the Federal Reserve, tech stocks were cumulatively on a decline from 1st March to 16 March. Then at the night of 16 March, the Fed actually raised 25 basis points. And then towards the end of March, we saw that tech stocks actually rallied. So I actually monitored this after I saw this article, which came out from Bloomberg, that it says that what happens after every first rate hike of the Fed. And they actually track multiple cycles of the past 8 cycles of rate hikes. And after the first rate hikes, the next 12 months is always positive. Of course, the next quarter is still jittery, but over the next 12 months, the US market always turns positive after each rate hike cycle. So surprisingly, that actually turned out the way the article actually portrayed, which we saw in Malaysia that happened for a bit. So, but I believe this is to say that over the next 12 months or so, people will start to, digest the impact of inflation rates, and people will start to see that actually tech companies don't really rely on bank loans for their expansion, because again, they have actually net cash in their balance sheet, and their expansion can carry on as usual. So rate hikes, not really a big hindrance for the local tech sector per se. So on that front, Yeah, so that's why I'm not only concerned on why whether rate hikes will actually impact, again, expansion of said local companies. I believe they can still expand with the cash pile they have on hand. But another thing to actually pay attention to in the market is the KLCI review. So fortunately, last year we saw a tech stock that actually went into the KLCI, which is first time in the history that there's a tech stocks in KLCI. But come June this year, where the FTSE Russell will actually do their next review on June, but they were based on the closing of 23rd of May. And unfortunately, this tech stock would most likely have a high chance of being eliminated, simply because the ranking actually came down quite a lot due to the market cap decline. But more importantly, it's because Hub Sing actually went above the rank of 25. So how KLCI work, as many of you are familiar already, is that if any non-KLCI component actually rise above 25, it would be included. And the company in KLCI that is on the last ranking would be eliminated to make way for the new entrant. And looking at this market cap as of today, you can see that Hub Sing is standing a very good chance to actually be entered at the expense of maybe Inari being eliminated. So this is why I think some of you may be wondering why Inari is seeing quite a lackluster performance in comparison with its peers. This is one of it also. But this is very company specific. So being in the KLCI could be a double-edged sword also, if the position is not maintained well. Yeah, so this is something to take note of. This means I don't think Inari is a bad company. In fact, I believe Inari is one of the best company in Malaysia in terms of the management and the way the company operates. But at this juncture, it seems that this KLCI review would pose quite a negative sentiment towards it, because as you know, all the ETFs that are tracking KLCI would have to rebalance their ETF position. And if Inari is removed out of KLCI, they like it or not, those passive ETF have to rebalance and sell off their position and have to buy Hub Sing consolidated. So that is the thing that is going to impact it. Okay, so this brings me to basically my top picks. So after going through the whole start of fund flows, the macro things that is happening, how interest rates and rate hikes are affecting, and also touching on how should we navigate through with the valuation maps that I shared just now, I have selected 3 stocks. So the first one is Kellington. Why I still like Kellington is because it is a proxy to the front-end semiconductor expansion. As you can see, Kellington, when we first covered Kellington, I think many thought that Kellington is a oil and gas company. But later, only people start to realize that actually Kellington is not oil and gas. They are actually very much related to the semiconductor space. So for those who are unfamiliar, Kellington actually does, they help to construct those high purity gas delivery systems for the likes of Micron, Western Digital, SMIC, TSMC, Siltronic, Global Foundries. And whenever a new plant is being built, or a plant or existing plant is going through expansion where they bring in more equipment, Kellington's expertise is needed, because they have to help to construct those systems for them, and also do a hookup job connecting the gas delivery system to the equipment. And this is where Kellington's niche is at. And if you look at for the past 2 years, 2020 and 2021, you can see Kenangton actually benefited a lot because of the tech cycle run, and a lot of companies were expanding. So these are the jobs that they got recently is Western Digital, as you know, with the 420 million jobs. This is a turnkey job in Sarawak. Then they get a 100% win rate from Global Foundries in Singapore. Then they also win the award from Micron in Singapore, who are expanding their memory foundry. And also they actually got a new job from Siltronics to build a new wafer foundry also. And I think if you see today's announcement this evening, they got another 80 million job award this evening just now. And this is from Beijing. So they say it's from the largest wafer foundry in China. And as you can guess, it is SMIC. So they have been getting a lot of good contracts, and everyone is saying that Kenangton has gotten so good of a run in the past 2 years. But what about 2023? Can they actually repeat the kind of success they did? So everyone knows that more or less 2022, they have an order book of 1.1 B, and this would easily bring them to another all-time high record earnings year. But people always thought that 2023 would be a fall off the cliff, but that is not true, because if you look at their tender book, currently the jobs that they are tendering at is at 1.9 billion. So it's double their order book. And for 1 year, they could only, I think last year they only did like 500 million. So this 1.9 B is going to be easily could cover them for 2023 already, as you can see. So I believe this company is still very much underappreciated, like, in a sense. And it is quite hard to find another company listed in Malaysia that actually does what Kenangton do. Some may actually be confusing Kenangton with, say, other construction companies, because you say, after all, Kenangton only does the installation of those gas system and also piping and civil jobs. But it's actually quite different, because if these jobs were so easily done, you don't see Gamuda or Kim Loon tendering for jobs in Micron or Intel or TSMC. So what Kenangton does is actually very niche, and there's still quite a lot of people that don't know how to appreciate the expertise that actually Kenangton is actually benefiting from. And if you actually follow the what TSMC is saying, they still see a lot of growth in the semicon market going forward, and expansion will likely continue. And this is why you see that tender books is up to 1.9 B. It's even higher than say 2020 or 2021, because there are a lot of tech companies are still seeing the need to expand. And that's why I still like Kenangton, because it is a good proxy to the front-end semicon expansion. So you have outperform call with a TP of RM1.90. And we look at the PE, in terms of forward PE, they are trading at, I think with today's decline, it's probably at 15 times only forward PE, which is worth the look. I think it's really worth the look at 15 times forward PE. So this is KGB is one of my top pick for a sector. So the other two picks is MPI and D&O. Just as a summary here, you can see that laptop, smartphone, tablets, I'm actually neutral. Again, I explained earlier, it's because of stabilizing shipment orders, and those who have actually needed a new smartphone, new laptop would have already done so. But those who have actually bought a 5G smartphone or a 5G tablet are still not able to benefit what 5G promises, because there's still a lack of 5G infrastructure. And that is where is the sub-segment of tech that I'm still bullish on. And this relates to data centers and also 5G base station. And talking about data centers and 5G base station chips, I still like MPI, because MPI has a really healthy portfolio, and they have been actually growing their exposure in the data centers and the EV market. So if you look at their revenue breakdown, you can see 38% is in the automotive sensors. And for this automotive side, what is there to look forward in MPI is that MPI is the only packaging company in Malaysia that can actually do this silicon carbide packaging and gallium nitride. And for those guys who are familiar with those two materials that I mentioned, you will know that those two materials actually is a new level of semiconductor materials that is going to be adopted in the semicon market. Currently, adoption is still quite low, but it's going to be the next gen or the next level that's going to evolve the semicon market. Currently, we are still using common silicon because silicon is one of the top 3 most abundant material on earth. And common silicon is what tech companies has been working on or building their chips on for the past many decades. So we are very familiar with how common silicon work. The price, the cost to reward ratio is very favorable. We have actually sort of almost perfect the use of common silicon in the production of chips. But when it comes to silicon carbide or gallium nitride, those materials are still very new. They give a lot of much more advanced properties, but the yield rates are not that good yet because it is quite tricky to deal with new material. For say, silicon carbide, for example, it's basically you are adding the element of carbon into common silicon. And by doing that, you generate a new material called silicon carbide. And if you replace it with, say, the drivetrain of a EV car, instead of using common silicon, you use silicon carbide, you are able to charge the car faster, twice the speed. And your driving range with the same battery pack can able to last maybe 20, 30, 40% longer. And this has been done by the Tesla Model 3. You can see since their facelift, I think 1 to 2 years back, they started experimenting with silicon carbide. And you can see the Tesla Model 3, the driving range has increased tremendously. This explains why Tesla supercharger can charge at a much higher voltage, because silicon carbide is able to handle that higher voltage of charging temperature compared to common silicon. That's why the cars can be charged faster. So this is something that is still very new in the tech space. In terms of commercialization, it's still not there, but it's something that is very promising. And you can hear a lot of companies, global companies or local companies starting to talk about this thing like silicon carbide, gallium nitride. And MPI has started it, say easily 3 to 4 years back. They started to qualify for it, and I believe they are still the only company in Malaysia that can do that kind of packaging. So this is something that is going to continue driving their automotive segment. And for the data center side, as you know, with the proliferation of 5G, again, there's more data needed to be transmitted. And again, which means that physically back end, there's data centers that still need to expand. And this is where data centers is still the part that I'm still bullish on. So in terms of the PC laptops, you can see MPI is only having very little exposure. So even though with PC laptops stabilizing, it's going to be not their core focus. MPI is still focusing on automotive and data centers. And the thirdly is D&O, is still my top pick, simply because of their prospects coming from automotive semiconductor LEDs. And if you actually understand D&O thoroughly, you will know that D&O is not an OEM. They do not manufacture for other brands. They actually, D&O is an OBM. So they manufacture their own brand manufacturer. And D&O is top 5 in the world. They are competing with the likes of Osram, Nichia, Lumileds. So they are not a OEM factory in Malaysia which makes LEDs for another brand. So they are manufacturing their own brand, they are selling under their own brand, and they are competing with the the largest player over the whole world. So if you understand D&O, their LEDs actually goes into say the Lamborghinis, the Porsche Macan. 60% of all the lighting in the BMW X series are all coming from D&O. So you can see that how D&O, although it sounds small because you say it's a Malaysian company, but it's actually competing on a global scale, that position. So that's why I think they still they are still the companies that deserve that kind of valuation on that company, because they are the only one in Malaysia capable of doing that. And the barrier to entry is so high, because if a new competitor would want to enter the automotive market, basically you have to be running a qualification stage for 2 to 3 years. And after, say, BMW qualify you for 3 years, doesn't mean you get orders. Once they qualify you, doesn't mean they'll give you orders. They might say, yeah, okay, you passed my qualification, but I may not want to give you orders. So the automotive game is actually seeing quite high barrier to entry, because you might have to burn 3 years of R&D, but you don't get anything. So that's why D&O's position in the LED automotive market is so secure, because they have been there for many, many years. And as you know, the key management came from Osram before. So he has the expertise and the know-how. And going forward this year, you can see a lot of D&O's lighting going into the EV market. And there's more than 20 over EV models that will be adopting D&O's LED, because D&O has this new LED called Smart LED. Basically, what Smart LED does is that it is able to generate, it's basically a RGB kind of LEDs. So as you know, going forward in EVs, you see that interior lightings and exterior lightings are one of the key features to actually distinguish between a petrol car and an EV car, because EV car seems to have, the car manufacturers are going towards the trend where they'll use more body lightings, more interior lightings, and then you can change the color scheme of the lightings in the interior. So those smart LEDs from D&O are able to do that, and they are able to consume even less energy compared to the traditional LEDs. So this is important for EVs, because EVs run on, again, battery, and you don't want to be fitting so much LEDs at the expense of draining out your battery and shortening your driving range. And this is why D&O's Smart LED is one of the leaders in the market. And if you follow the automotive LED space, you'll know that D&O's LED are actually on the forefront in terms of this kind of smart LEDs compared, say, or even to Osram. So yeah, so that's why I think these three names are still quite a solid name. They are in the categories that I'm still bullish on, which is data centers, 5G base station, and also EVs. And they have little to no exposure to the smartphone and laptop segment, which I believe is going to be neutral going forward. So that's all from my side, and I'm happy to actually take some questions. Pass back the time to Shane.
All right, thank you so much, Samuel, for a very comprehensive view on the technology sector outlook, as well as sharing with us some of your topics within the sector. I can see that our Q&A box is filled with questions to ask you about the tech sector. But yes, if you have more questions, you may write in the Q&A box, not the chat box. Remember to write in the Q&A box so we can better manage your questions. Of course, the question will just limit to the scope of technology. Okay. So the first question is by Anthony. With the concern and sensitivity of semiconductor lockdown and also technology secrecy, and also concerns of concentration in Taiwan and overseas, will US companies try to source from US suppliers? Will it be better for US semiconductor companies?
Good question. I think it is all down to, I think if you trace back long time ago, US has been known for, I mean, back in the days of IBM, you know that they are manufacturing their own chips, their own things. But then after some time, US think that they don't want to do the manufacturing jobs. They want to pass the manufacturing jobs to the Asia market and focus on designing. And this is why you see even IBM sold their ThinkPad to Lenovo. Then a lot of companies don't produce their own chips anymore. If you see even Apple, Nvidia, Qualcomm, Broadcom, all these, we call them fabless because they don't own a fab. They just design, send their blueprint to TSMC. So this has been done for the past, I think, easily decades or so. And for US to take back to do manufacturing, I don't think that is quite possible due to the disadvantage they have in terms of the cost of labor. So can US do manufacturing again on chips? They can. They have they can do it. They had done it before, but whether they can do it with the same yield rates and with the cost effectiveness as, say, Taiwanese TSMC, I highly doubt so. So on that front, I think it is still going to be very orientated on Taiwan being the key manufacturer of chips, Taiwan and China, SMIC. But interesting to note is, I think, just sharing some fun facts, is Intel is working on their IDM 2.0. So as you know, Intel took in a new CEO, and Intel has been suffering, as you can see. As you see your laptops on the shelf selling in Laoyat, you will see more laptops powered by AMD, because AMD is a fabless company. They do their manufacture, they send their blueprints to TSMC to fab, and then they sell their AMD chips and it's fitted into laptops. Whereas Intel on different. Intel is not a fabless company. They own their own fab and they produce their own chips for their own use. And for the past 2 to 3 years, they have been suffering at the 10 nanometer level because they are not being able to miniaturize to 7 nanometer simply because they hit a limitation on their expertise. Whereas TSMC, on the other hand, they have been doing for Apple, Nvidia, Qualcomm, Broadcom, whichever you name, I think TSMC has done for them. So TSMC has that capability and the expertise to improve so fast compared to Intel. And that's why you see AMD, who rely on TSMC, managed to surpass Intel in the consumer market. But interestingly, after the new CEO came in Intel, they want to revamp the Intel philosophy. So instead of producing for own use, Intel is working to expand more, increase their R&D, and eventually they want to become like TSMC, where they open up their factories for external parties to use their facilities. This is still too early to say what will happen. Will there be more competition with TSMC? Maybe, but from the latest con call with TSMC, TSMC say they are still very confident with the customers they have, and the expertise and the leadership that they are commanding now in the manufacturing market. So near term, I still believe it's going to be the Asian market dominating the production side. Yeah.
Okay, understand your point of view. How do you see the chip shortage issue? Will you think it will persist for some time?
Chip shortage is very wide. Yes, it will persist, but for a more specific answer, the chip shortage relating to smartphones, tablets, laptops, that is going to stabilize in the near term, because, as you know, again, shipment are stabilizing already. So if you look at TSMC latest announcement, you can see that what drove their growth in the latest results is automotive and also the data center side. For the smartphone side, they also say it's stabilizing. So on that side of things, I think the chip shortage on the end consumer devices are stabilizing, but what is going to continue in shortage is those in relation to automotive, EVs, and also what you call your data centers, 5G base station, RF. And to some extent, if you see headlines on some car manufacturers, they say due to chip shortage, they are shipping out some of their car models without Android Auto, without Apple CarPlay, because some of the chips, they just have to prioritize on those features that actually take care of the safety of the car. And those Android Auto, Apple CarPlay, those kind of features are more of a good to have, but not necessarily a component that drives the car. So some of the models are being shipped out with those features. So on that side, automotive, I think the shortage would still continue towards this year.
Okay, I see. Thanks, Samuel. Now, we know that part of China is being locked down. So the next question by Mr. Yap is that how huge will this China lockdown affect D&O earnings in the coming quarters?
Okay, that's a good question. For D&O, fortunately, D&O's production is all in Malacca, as you know. So no issues on production in Malaysia, because Malaysia is open. We are free to go about our daily operations. But what could be the potential challenge is that D&O has a lot of customers in China, but D&O don't have production facility in China, but they have sales team in China. As given our last engagement with the D&O management, orders on hand are actually quite secured up to middle of this year already, June. So they just need to produce, and then they can actually meet the kind of earnings forecast that analysts are expecting. But going forward, maybe in the third or fourth quarter, in terms of bringing in sales for those quarters, if the lockdown continues, then maybe there will be some kind of challenge in terms of the sales team to engage new customers. But for existing customers, it's actually quite, it is not too much of an issue. It's just that the lockdown may obstruct the sales team from meeting new customers, so on and so forth. So I don't see a huge impact on the production side.
Okay, understand. So what is your view of DNEX and Silterra? Could you offer some?
DNEX and Silterra. So it's quite interesting. Personally, there was a few bidders for Silterra, and of course, the one that won it, DNEX, is actually not expected at all in my perspective. So of course, you will see that Honhai was one of the bidders, Foxconn, XFab from Germany, who operates a fab, was one of the bidders. But I think somehow, due to Malaysia wanting to keep things local, they actually awarded it to DNEX, who has close to zero expertise in operating a wafer fab. So, but can things turn around? Can, but it actually requires a lot of expertise. You require more talent than money, because you say for the past decade where Khazanah was operating Silterra, no matter how many millions or billions you pump in, you are still making losses. So operating a fab really requires talent. And for DNEX side, I think a good thing, they're partnering with a China fund, I think a VC fund, so they can get some expertise through the VC fund to run that space. But can it turn out well? I think there's still some time to see. Of course, you cannot compare DNEX with, say, Intel or TSMC. They are basically light years apart. But DNEX or Silterra will focus. To give you a comparison, I think Silterra is operating chips at maybe 90 nanometer and above, whereas TSMC is manufacturing at 3 nanometer. So that gap is basically easily maybe few decades apart. So they can never compete, but they will be operating same as what they are doing now, 90 nanometers and above. Maybe for more the automotive market, they can't go into the microprocessor market. due to the limitation of expertise. But can they turn it around to be successful? I think hopefully, but I think it's still too early to tell because after all, DNEX, the run, I think is mostly likely due to oil price, because DNEX is an oil company to start with, and Siltera is something they inject in later on.
Okay, thank you so much for giving us your 2 cents worth of idea about the next. Now, in line with the Made in China 2025 initiative, so many tech companies have tried to expand their business in China. For example, GF Tech, Analyst. Would you be able to comment on their prospects?
China, Emulous. Okay, yeah, true. They have been expanding a lot in China. Basically, what Emulous is trying to do is create a machine that competes with the Western name without using Western parts, so that China buyers or China customers may be more may welcome those kind of cheaper machines without US parts, so they can use it. But if you look at Emulous currently, I still see 60% of their revenue comes from the smartphone, the equipment that is used for smartphone. And honestly, if you follow my thesis just now, I'm actually turning neutral on smartphone. So Emulous still have the data center equipments that is used to produce data center chips, but those are still maybe 10-20% of their total revenue. 60%, 70% still come from smartphones. So they will still benefit from the whole China thing, but I don't see smartphone growing so strongly in the near future. So in short, is that with valuations all coming down, and I'm trying to pick on names and prospects of companies, smartphone is not the first thing that comes to mind, unfortunately.
Okay. Now, Great Tech just released their latest quarterly report, which show lowest profit versus preceding quarter. So is there any reason for us to be alarmed?
Actually, it is quite normal for the March quarter, that means January, February, March, to have actually Q-on-Q lower revenue and lower profit. So I think with the result season approaching towards the second half of this month, first quarter is definitely, it's very hard to find a company that can do better than the fourth quarter last year. So the Q-on-Q decline is actually quite normal. This is how tech cycle has always been. So first quarter, because of Chinese New Year break, lower working days, then first quarter is also the low cycle. And when you ramp, let's say China, you got one big break. Then when you ramp down your production, it takes 2 to 3 days to ramp down. Then you ramp up again. It also takes 2 to 3 days to ramp up back to the optimal level. So with the shorter working days, definitely Q-on-Q is given to be a decline. But it's normal. It's normal. It's not something to be alarmed.
Okay, normal. Okay, so let's do one last question. So in terms of timing, I think generally I can sense that Samuel, you were quite bullish about the technology sector earnings going forward. But then Nasdaq is still retracing. So what do you think should retail investor do? Or should we wait before we start to collect the recommended stocks, or or should we go in, allocate a portfolio some now?
I think it's good to look at some of the names now. Of course, again, I also mentioned that the horizon now has to be longer. We cannot use the same mindset and the same horizon we have actually been used to in the past 2 years, where 1 week we can see substantial gains already. So stripping out that kind of mindset and going into a more longer horizon, picking those fundamental names, I think it is good to allocate portion to actually into these names. Of course, I still support the statement that you say to go in progressively. Looking at Nasdaq's decline is close to what the initial decline of the MCO1 that started in 2020. So seeing that the quantum of decline is almost there, and with the view that I don't think that tech stocks will go back to pre-COVID era, because to me it's just not justifiable, I would see a good chance to allocate progressively on names that actually have good fundamentals and valuations are favorable. So again, I will refer back to the valuation map that I share in the Excel spreadsheet just now, where you see some are actually below their 5-year average and still have good earnings on the way. So yeah, that's how I would navigate.
All right, thank you so much, Samuel. Of course, we still have quite a number of questions on Q&A panel, but then we have overshot the session by 10 minutes. So we shall conclude the question and answer session today. So let me take over the screen control. So thank you very much, Samuel, for doing this segment for us. So if you want to join the next CanTrade webinar, we have invited the managing director of Tune Protect Group to join us to do this segment, which is live chat with Tune Protect Group Berhad, spearheading a tech-led insurance proposition. All right, so it's happening on the 2nd of June 2022, 8:30 to 9:45 p.m. Have given you the registration link to attend the session. So if you want to learn more about how this Tune Protect Group works, what is the business model, what are the futures prospect like, so what are the financial numbers for the quarter, the breakdown, and so on, analysis, please tune into this session happening on 2nd of June on Thursday. So to learn more about Tune Protect. All right. So for those of you who haven't had a Kenanga share trading account, you may fill out this online form. Head over to www.cantrade.com/account-open-account-form. And if you haven't joined the Kenanga Trade to Win Telegram channel, you can click the link here, Telegram channel /Kenanga Trade to Win. If you need trading ideas, what price to buy, what price to sell, you may join this Kenanga Trade to Win Telegram channel to get some trading ideas. Okay, the licensed analysts are there to share with you trade ideas, okay, on what you can do in this market. So with that, I would like to thank Mr. Samuel Tan, the Senior Equity Analyst of Kenanga Research, for joining us in this session to tell us about the technology sector outlook. I hope all of you here have gained enormous value from this session, and hope to see you all in our next CanTrade webinar.
Thanks, Shane. Thanks everyone for dialing in. Have a good night and take care.
All right. So take care, everybody. Have a great rest of the day. Bye.
Bye. Thanks.